All right. Hey there, you have reached the Gen Xers in Low Country channel. Again, we're so grateful to have you here. Thank you for coming to our live stream.
We're live.
Ta-da. Listen, if you are watching live, we're grateful you're here. If you're watching this on replay, hit replay in the comments so that we know that you, I don't know, watched it, I guess.
Yeah. Sure.
So a couple weeks ago, we had Max Ballard on, and he was our local lender, and he teased a little bit about reverse mortgages.
Mm-hmm.
He was like, we could talk a little bit more about that another time, Angel. And I was like, you know what, Max, we probably should, because go on.
Well, and with the response we got to the last video, people are hungry for more.
Yes. So we're going to bring him in. Here we go. Max. There
you
are.
Hey guys, how are you?
Great.
Glad you're here.
Good. Thanks for having me.
Yeah.
Welcome back.
Okay.
We're talking about reverse mortgages.
Yes.
The first thing I want to, talk about, the elephant in the room, is the misconception about reverse mortgages. Like, you'll have people that say like they're bad and it's a trap, and there's something hidden in there.
They're going to foreclose on you. It's just a way to foreclose.
It's going to get you later. So can we start off by talking about where that comes from? And
yeah, sure. And it's there's a lot of stigmatism and mistruths about reverse mortgages, and there's if you remember all the late night infomercials back in the 90s, the Tom Sellecks of the world, and they're, hey guys, it's like, so yeah, a lot of family members think this is some way that their parents or grandparents are going to get duped into losing their house, losing their equity, losing these things, and that's just simply not true. The loan itself came about in the late 80s. There was during the Reagan administration, the Housing Community Development Act was signed into law in 1988 by Reagan himself. This was something that his team came up with, and it's like, hey, how do we help our senior citizens to live beyond their retirement years and utilize their equity to do that? It's not just relying on your fixed income, your Social Security, your retirement, your pension, which we talked about the last time, which a lot of people don't have, but it's like so many people, and if you look at the numbers right now, 10,000 people a week are retiring up until the year 2030. So that's quite a few Americans. All the boomers are hitting the retirement age. These people in aggregate hold almost $3 trillion in wealth and equity in their homes. So a lot of people, have the means to tap into this equity with a reverse mortgage. And, the reverse mortgage, like I said, the out there, the reverse mortgage is the same as any other mortgage. The only difference is payments are optional. And this is ideal for people on fixed income who may only bring home $2,500 a month or $3,000 a month, and their bills, all of a sudden, if you're in an environment like we're in today, where mortgage rates are 7 and car rates are 8 or 9,
and eggs are $25,
and eggs are non-existent, right? It's like all of a sudden your grocery bills, all these things that catch up with you as a senior citizen, it's out of your reach, or you're struggling to get to it. So like I said, this is a great product that the Reagan administration came up with. It's an FHA insured loan, and it's a way for seniors to tap into the equities to supplement their income, to supplement their lifestyle, to make changes if necessary to their home, to prolong the, ramps, handrails, a walk-in bathtub, all these things that can help them to age in place. So it's, like I said, all the monikers are out there that it's a bad thing, but it's really, if you look beneath the surface and educate yourself, it's a great thing, in my opinion. So.
Yeah, thank you for that. And how would you say they differ from like a traditional mortgage? Can you kind of explain
Sure. So it's based on the approval process is pretty simplistic. It's based on your age. You have to be at least 62. It's based on the value of the house.
You have to be 62. I didn't know that.
You do have to be 62 for the traditional HUD insured one. Now, there are some private lenders who have products that will allow you to do this at the starting age of 55.
Okay.
But for the most part, this is designed for, seniors that are 62 or over. So the age is a qualifying factor. The value of the house is a qualifying factor. and they come up with, based on your age and the value of the house, what's called the principal limit. The principal limit is the starting loan amount, and it works just like an equity line in that you're getting access to funds. Some people can take that as a lump sum distribution. Some people want to take that monthly. You can take it however you want to take it. If you want to simply get online with your servicer and say, hey, we're going to Greece for the summer. We need $20,000. Can you wire that to our account? So it's different in that sense, in that the way the principal limit is designed and come up with. It starts off at very low loan to values in relation to the value of the house, because the idea is they don't want people to ever outstrip the equity in their house.
Right.
The interest, if they're not making payments, the interest is accruing on this loan. But at the same time, if you look at our market in particular, we've seen, I don't know what, 20, 30, 40% gains in value over the last 3 or 4 years. So there's always the appreciation factor is building. So their line also builds at their rate of interest each year. So they're having an increase in funds that they can access year after year.
Yeah.
Okay, my realtor brain's about ready to explode with this question. So when you're talking about the value, are we getting the house appraised before we meaning the homeowner, are we, is that, so the appraisal is going to happen straight away because they have to know what they're tapping into. Yeah.
Correct. And
okay.
Being that this is an FHA insured loan, the house has to meet FHA guidelines. So if there is some deferred maintenance issues or things of that nature, there may be things that have to be taken care of with the house before the loan can close. So yes, the appraisal has to be done, and these can be done on a purchase transaction as well as a refinance transaction. So if someone is selling their house from New York, they're bringing $800,000 down here and buying a $1.5 million house, they can conceivably put cash into it and finance a portion of it and not have payments on that loan, being that it's a reverse mortgage. So we see that people, this is part of their estate planning or their financial planning. They say, hey, we're bringing all this equity. Here's our lifestyle. Here's what we want to do, but we don't want to make mortgage payments. So this is a way to preserve some of their capital. So it can be used in a lot of different aspects because of the fluidity of the loan.
Okay.
And then speaking of the appraisal, can you kind of walk us through, if I'm a client coming into you for a reverse mortgage, is the appraisal the first thing that happens? Can you walk us through the steps?
Absolutely. Great question. So actually, step number 1 is I would send you guys or whoever the client is a proposal. It would break out all the details of what we're looking to do with this loan, the starting principal limit, how much you're going to be taking in advances at the closing, et cetera, any liens or things that we're going to be paying off. Once you say, hey, yes, this looks great, let's move forward, you would sign loan disclosures just like any other loan. And then the next step would be you would go through a HUD counseling. And the HUD counseling is designed they will take this exact paperwork that I've sent you. There's a code on it that the HUD counselors can access. They will take you page by page through every single document and answer all your questions. And you could be on the phone for three hours if you want to ask all the questions that you want. But they want to make sure you understand the loan, that you understand you're putting up collateral, that this loan does carry interest. They walk you through the whole details, and you get a HUD certification certificate before we can move forward with ordering the appraisal.
And what's that timeline? Obviously, we're not going to be on the phone with them for 3 hours, but are we talking is this a week? Is this 10 days, a month?
It's pretty quick. The application part itself, depending on how much back and forth and questions between the client, that can take a few days. Okay. The HUD certification is dialing an 800 number and setting up a time with them to do this on the phone. So usually that's done within a week or less. The appraisal is done within a week or less. So if you're looking at this on a timeline of a regular, normal forward commitment loan as compared to the reverse commitment loan, you're talking, 35 to 40 days on average to get one of these closed.
Yeah. Standard. Mm-hmm.
Yep.
Yeah. And I'm sorry, this might be one of the questions later on, but we're of course we're always talking about it for the sexy. I want to go to Italy for a month and a half and I want to, all the sexy, but if there's a tragedy, if there's something that you need money for straight away, and you know you're sitting on equity in your house, this can be done for that too, right? You don't have to qualify what the money's going to be used for, or do you?
Correct. The lenders, they really don't care how you're using the money for this. I will
Okay.
say there are some bumpers on this on the front end. You do not have access to 100% of the line when you close. They only give you access to 60% in year number one. And
Oh,
the
okay.
main reason for that is sometimes there are some bad actors in the family or around these seniors that are kind of forcing them into scenarios to take money out for their needs
Sure.
and not the
Read
seniors'
my
needs.
mind.
Yeah.
So this is one of the safeguards that's built into the loan is you don't
Yeah.
get all that money at once. It's structured, you can get up to 60% on the first draw, and then it becomes available after month 12.
That's
So
smart.
That's
Yeah.
managing the risk. I
That's
like that.
good.
I
That's
like that.
good.
Mm-hmm.
And
it
then,
is, and there's, go ahead.
okay, I was going to say, speaking of family members, how does it impact the homeowner's estate and like an inheritance sort of situation?
So, like I said, this is a mortgage just like any other mortgage, and at the end of this, if the senior has to go to say assisted living and they're not going to be occupying the home for if they're out of it for 60 days plus, typically that will trigger a repayment event. Now, if they're temporarily going to assisted living and they're in rehab or something like that and planning on coming back, the lender
Mhm.
can work with them on those aspects. But if you have a husband and wife and one goes to assisted living and one stays in the house, the loan is not repayable until either both of those people are not living in the house anymore for 60 days plus, or they both pass away.
So then,
Now,
I'm sorry.
go ahead.
Yeah, go ahead. No, I
I was
want to
going to
hear
say
the rest of that statement.
when that happens, so you're going to pay this mortgage off just like any other mortgage. There's
Okay.
principal and there's interest that's accrued. Because of the nature of how this works, and usually it's up to the very end stages of life for folks. If somebody does pass away, the heirs will have up to 6 months to pay the loan off. So it does give them quite an ample amount of time to list it and sell it or refinance it,
Okay.
whatever the per the will
Mhm.
to do with this house at the end.
Yeah.
The nice
Yeah.
thing about this is the only loan that I am aware of that if for some reason the proceeds or the loan that they took out exceed the value of the home, they can actually, the heirs can ask for a reduction in the principal owed of 5%. So if they owe more than the house, they can have the principal reduced by 5% if the occupants or the borrowers, it was death that caused them into this repayment situation. So like I
Interesting.
said, this is the only loan that I know of that has those precautions built in there. So there's lots of bumpers around
Yeah.
this. And like I said, once people start digging into it and reading about it and understanding it more, you go, hey, that doesn't sound so bad,
I
So
have to say, I'm one of those people. So I have got, I don't know if you can see them, but I've got light bulbs going off all
right.
over my head. I'm like, oh.
Yeah.
So
That's good.
I really appreciate this information because I don't know that I had the most favorable opinion of this, but I'm happy to be changing my opinion and at least opening my mind a little bit to it because we deal with people in all types of situations, moving for yay, moving for yeah, all kinds of reasons to move. But sometimes you get in those situations with elderly people where you have to make decisions, and we wouldn't be serving our clients well if we didn't know every single option to offer them.
Right.
So I really appreciate you breaking this down and making it simple for us to be able to explain to them going forward.
Yeah.
Don't want to borrow trouble, but
Yeah.
want to make sure we're, satisfying what they need to have done.
Yeah. Well, and then a follow-up question I have as far as like an inheritance thing is, do you recommend that the kids of the parents, like, because then I think about, okay, what if the house goes to probate if they didn't have it set up properly and they've got 6 months to pay off the debt? Do you have any advice on that? Or
I mean, I would say that any stakeholder needs to be involved in this process, that the children, the heirs, the whomever, the financial planner, whoever's administering their will, anybody that wants to become informed and be part of this process, I would say engage that. Let's make sure everyone is out in the open and understands this thoroughly going forward. But, this, like I said, it's a mortgage just like anything else. So as long as they have set up their will, they shouldn't necessarily have to go into probate. I mean, South Carolina, I know every state has different laws with how that's handled at the end. but
Right.
however they designate for their home to be sold, to be granted to their children with however that flows is work the same way as any other mortgage does at the end.
Okay.
So,
Mhm.
Okay. That's helpful.
Yep.
Yeah.
Yeah. Did
Yeah.
we get all of our
I
questions?
think.
No. Well, and did we cover everything that you get asked the most, by the way?
Is
Like
there,
you
is there
get...
anything we're missing? Or?
yeah, I mean, everybody's like, "Hey, what's this sounds too good to be true? What's behind the curtain?" You know. So,
Okay.
Right. Yeah.
like I said, there's nothing behind the curtain. The only difference in this loan compared with a normal line of equity is, there is no repayment unless you want to. And I have a lot of people say, "Hey, we're willing to pay $200 a month. Go for it. Pay
Mhm.
pay whatever you want to on this loan. You don't have to,
Yeah.
but you can."
Yeah.
It'd be nice if we could all just make interest only payments on our loans, and with this loan you could. The other thing is the credit line growing over time. So a lot of people will start this off when they're 62, not touch it until they're 80, and by the time they're 80, that line has grown substantially to where if they had some
Yeah.
significant needs or lifestyle changes, or like I
Right.
said, a lot of people need an elevator in their home, or they need a ramp, or they need something to help them age in place. And that's, like I said,
Right.
this loan has lots of different purposes. It's not just about going to Italy for the summer or whatever else. It's, a lot of people, it's not for everyone, but
Yeah.
a lot of people who even have the means to survive without this, they're coming in, purchasing a home with a large down payment and saying, "Hey, I want to keep my $2 million in my Fidelity account that's earning me 20% a year. I
Right.
don't mind
Mhm.
paying 5.5 or 6% in interest on this amount of money, or having
That's
having
smart.
that accrue, because that lets me not touch my assets." So there's lots of different questions, lots of different scenarios. It's never going to be the same for two different people,
Right.
So, but like I said, I would be, your clients are interested in this, that they dialogue with their mortgage person, have all the stakeholders involved in the conversations, and make sure everybody is aware of what this is and what they're planning on doing with it going forward.
Mhm.
And clearly you are, the mortgage person that you just mentioned, because
Right.
you are definitely showing your expertise in this. And again, we appreciate that. I did have a follow-up.
Sure.
That you were talking about a 5 or 6%. Are the rates on this loan or this equity draw, reverse mortgage, are they comparable to like what today's rates are, or are they different?
Yeah, they're cheaper.
They are, and there's two different types of these loans. One is a fixed rate where they take a lump sum distribution and that's it, and it's on a fixed rate.
Okay.
I don't know of anyone that's doing that right now. Now that the mortgage rates are 6.5 at 7, because you're
Right.
starting at a rate that is pretty high, that's going to
Yeah.
remain constant unless you refinance it. The
Right.
equity line, or HECM, is what we call these draws. It is tied to the 1-year constant maturity of treasuries. So when you hear that the Fed is cutting rates, that is directly impacting these rates because they are variable. They're tied to the bond markets.
Yeah.
So the rates do fluctuate. So if you had this
Okay.
loan in 2021, your rate was 2% because it's fluctuating with how the bond market fluctuates. If you
Isn't
have
that
this rate
adorable?
today, right, you're looking between 6 and 6.5, something like that. But hopefully
Okay.
these rates are going to continue to come down as
Right.
the
Right.
economy gets better and as inflation gets better. But it's hard to say what that rate's going to be on the long timeline. If you're in this loan for 20
Yeah.
or 30 years, I mean, there's an average. We print out all these amortization schedules to show people, hey, worst case scenario, this is what it could look like at the end, so that
Got it.
they can plan that for the future. Yeah.
I love that. I love that, because that, that's our love language, right? When we're in real estate, it's what you talk about, it's what we talk about, the rates, and, all of that. And there's no, this might sound odd, but I just thought of this question. There's no, I don't even know if it would be called PMI, but is there a PMI version for this, or no?
So that is a fantastic question. Because this is an FHA loan, there is an annual PMI factor, which is 0.5% that gets financed into the loan each year.
Okay.
That does insure the lender against any losses. So
Risk.
that is
Yes.
an added expense to this loan.
Okay.
Very, very good question, and I'm glad you brought that up.
Yeah.
So
Good job.
we've got just the framework is going to be, we got to get the appraisal. We don't have to say we're going to Italy. We don't really have to qualify what we're doing, why we need this money.
Mhm.
It can be emergent, or it can be like a long
Over
plan.
time.
Yeah, over time, over the next 15, 20 years. and and then the family isn't really dramatically impacted on the back end as long as they're involved on the front end. That's probably going to be the shortest way to handle that, right?
Yeah,
correct. And some people don't want to involve their family. Some people do. Like I said, it's probably conversation with everybody and say, hey, we're getting this loan. Do you want to learn more about it? Kind of thing. But the homeowners stay in their home. They maintain the payments on their own taxes and insurance on this because that is not a part of this mortgage. There's really no credit requirements for qualifying. There's really no income requirements for qualifying. So it's age and value of the house, and we go from there, kind of thing. So
nice.
Yeah, that is fantastic. So again, you've clarified yourself multiple times as the expert. Let's make sure I put your number in the comments below. But if they're just watching, whether it's live or on replay, hit us with how everybody can reach out to you, and then we'll hit with how they can reach out to us.
Yep.
Absolutely. I can be reached on my cell phone number is the best way, 843-200-6491. Or you can email me at max.ballard@grarate.com. And I would be happy to share any information or answer any questions you have on this or any other products. So
yes, and if you're getting ready to talk to Max, then you should probably be getting ready to talk to Dan and I here, the GenX team. We would love to hear from you. In the description below is the link to book a call with us, so we can kind of get the nuts and bolts of what you're interested in doing, whether it's where we get to talk to you and Max at the same time and figure that out, or if we're going to start looking for something for you. But our information is
our email address is.
It just left my brain. Go.
Our email address is genxrealtors@gmail.com.
Yeah. Lost my mind there for a minute. I might need lunch. But anyway, thank you so much. Happy Valentine's Day to you, Max. I hope you're doing something fun with your wife.
This is what I'm doing.
Hopefully so. I appreciate you guys having me on the podcast, and always a good time to share information with your clients and make them aware of just all the things out there that are available. So I'm
really grateful. You really opened up my mind in a way that I hadn't even really considered. So I appreciate it so much.
Good. Yeah. I'm happy to educate. So hope you guys have a great weekend.
Thank you. Talk to you soon. Thanks, Max.
All right, thanks. Bye-bye.
Bye.
Bye.